This video is part 2 of 3 about business ownership. We're going to talk about how corporations are formed, S corporations, limited liability corporations, not-for-profits, cooperatives, joint ventures, syndicates, and then we'll talk about things like organic growth of a company versus the growth through mergers. Okay, this is general information. Laws are always changing. Make sure you have the most current information before you make any decisions. A corporation is a legal entity that is separate and distinct from its owners. So the owners and the corporation are separate when it comes to things like lawsuits. The company can get sued, and the owners, the shareholders, the management are separate individuals. They can be sued, but again, if the corporation is at fault, the owners are a separate group of people that would have to be addressed. Owner liability is usually limited to the amount invested in the shares. So if you buy $100 worth of shares, that is your exposure. They cannot come get your house. They cannot come get your car. Money and liability are formally accounted for. Yes, in large corporations, you have double order entry bookkeeping. It's all very regulated by government, and it's all outlined very specifically. By law, they have many of the same rights and responsibilities as people. They're called a juristic person. It's not an actual person. This is also something that's been changing a lot. Corporations can enter into contracts. They can borrow money. They can loan money. They can sue. They can be sued. They can hire employees. They can own assets, buildings, property, so on. They pay taxes, and they engage in business operations. So in many ways, they are just like you and me. Corporations are about 20% of U.S. business, but they bring in about 80% of the sales. So kind of an interesting fact. Corporation definition. So let's talk some definitions that are important. Stock, ownership shares in a corporation. If their company issues 100 shares and you own 1 share, you own 1% of the company, and then you can scale that up as needed. Stockholder, a person, legal or actual, who owns 1+ shares of a corporation's stock. A closed corporation, a corporation whose stock is owned by relatively few people and is not sold to the general public. So you have Dell, Mars Candy, and other family companies. Open corporation, a corporation whose stock is bought and sold on security exchanges. So this is the New York Stock Exchange and so forth, and can be purchased by any individual. So for example, HP, if you want to be an owner of HP, you can go out and buy a share of Hewlett-Packard stock. Toyota, NVIDIA, any of these companies that are on the stock exchanges, you can go buy them. So let's speak about, in general, how you form a corporation. The term when you're creating a new corporation is called incorporation. The process in very general terms is you create a company name, you write articles of incorporation, you pay the government fees and taxes, you obtain the employer identification number, an EIN. You'll see this on your IRS forms. The IRS requires it, and it identifies the corporations as far as paying taxes, and you also need it to open bank accounts, apply for business licenses, and so forth. You need to hold organizational meetings. These are usually between the shareholders, board of directors, and the management, the executive management. You adopt bylaws, you elect directors, you pass operating resolutions, you draft corporate bylaws, and these are the regulations internally to the company on how you will run it. This is not what the government regulates. These are the rules about how you're going to run it inside. So let's talk about this in a little bit more detail. So the first thing is the corporate charter, and it's the articles of incorporation. I've got a sample first page of one over here. It's a legal document filed with the government to establish a legal business organization, and it's a public record. Public can view it, and they can look at all the information that's included, and that is stuff like the firm's name and address. So it could be James Co. in Anchorage, Alaska. Incorporators' names and addresses, so James, John, Mary, etc. So these are all the original people. Purpose of the corporation: we're going to make widgets in the US and we're going to sell them in the European Union. Stockholders' rights, including maximum stock shares and type of stock to be issued. We're going to say, for example, we're going to issue 10,000 shares of common stock. We have a mechanism for transferring stock. We're going to use the New York Stock Exchange. names and addresses of members of the first board of directors, so those were the people up here. Life of the corporation. Is it an ongoing corporation? Is it 10 years? Are we just going to run a project? We're going to build a bridge and then we're going to stop, whatever it is. The organizational meeting that we just mentioned. So this is the last step in forming the corporation. So the incorporators, these are the founders, and the initial stockholders meet to adopt corporate bylaws and elect the initial board of directors. So this is a little diagram down here about how things work. And board members are directly responsible to stockholders for how they operate the firm. At least this is in theory. In practice, it's quite different. Corporate structure. Well, the first thing is board of directors, and it's abbreviated differently in different places. It's the governing body of the corporation. So it's these people over here in this diagram. Its members are elected by shareholders in public companies, and they are to set the strategy, they oversee management, and they protect the interests of the shareholders and stakeholders. So the board of directors represents these people. The public companies must have a board of directors. Some private ones have them. Nonprofits also have them. Outside directors. So it's best when they are experienced managers or entrepreneurs from outside the corporation that have specific talents. So an outside director is someone who is literally from outside the company. They could be from another corporation. They could just be a consultant, but they come in and they have a specific expertise. So it could be an organization, competition, something like that. They're bringing in external information so that companies, especially the management, don't start breathing their own exhaust. Inside directors, they're high-level managers or key stakeholders. So example, a worker rep from inside the corporation. In Europe, this is more common. On the board of directors, you will have a representative from the labor union or from the workers who sits on the board of directors and also makes sure that they stay honest. Corporate officers, the chairman of the board, CEO, president, executive VPs, corporate secretary, treasurer, that's all these people down here. They are to implement the corporation's strategy and direct the work of the corporation. They report results periodically to the board and shareholders, and that's a requirement of law. This is a little bit bigger picture of that same thing. So here are your shareholders. They elect the board of directors. The board of directors are their representatives, and they hire the officers of the company, and the officers of the company are supposed to follow the orders of the board of directors. So let's talk about stocks, dividends, proxies, and things like that. Common stock, those are shares of a company. So when you buy stock in a company, you actually become a part owner in that company. If there's 100 shares and you buy one of those shares, you are a 1% owner in that company. You have voting rights on corporate matters. So whether it's executive compensation, auditor changes, stuff like that, you'll get a notification every once in a while to vote. You have claims on profits and assets, but they are subordinate. They come after the claims of others. So they're last in line when it comes to company assets. So if the company borrows a bunch of money, then goes broke, they have to sell the buildings and the machinery. The creditors get paid first, bondholders and preferred stockholders get paid before the common shareholders, and common shareholders get divided up in anything that's left over after these people get theirs. Preferred stock, it's a stock without voting rights. If you're interested, I'll go in detail in another video on this, but there's reasons they don't have it. Mostly it prevents voting against the interests of common shareholders. The preferred stock will have fixed dividends, oftentimes set when it's issued. So when they issue common and preferred stock, the common stock will float. The dividends will often float, but the dividends on the preferred are often fixed, say at 5% or 7%, and they will continue that way for the life of the stock. Preferred shareholders are paid after creditors, but before common stockholders. So yeah. Preferred stock is less volatile than common stock and is callable. So if they say we want those preferred shares back, it may come back as at market value, or it may come back at some fixed value that was predetermined. Dividend is a distribution of earnings, so it's part of the profits, and it goes to the shareholders. So at the end of the year, the company looks at the balance sheets, and they say we have a certain amount of profit left over, and they'll chop that up into pieces. They'll keep part of it for, say, investing in a new building or hiring new employees or something like that where they need to expand. The rest of it can be divided up and paid out to the stockholders. It's the interest on your investment in the company. Nobody's going to invest in a company if they don't get something out of it. The dividend will go up and down with the success of the company. In good years, you should expect to get paid more. In bad years, you should expect to get paid less. And a big difference between preferred and common shares: the preferred shareholders have priority over a company's income. They get paid dividends before common shareholders. So if there's not enough money, then the preferred get paid and the common do not. A proxy, I often get proxy statements. It's a legal document that allows stockholders to transfer their voting rights to another individual. It allows someone else to vote for you. A change that happened, I can't remember now, like 10 years ago or so, that if you do not vote your shares, in a lot of companies, you automatically are transferring your voting rights to the CEO of the company, which you may not want to do. Let's touch briefly on corporations and taxes. When you invest in a corporation, you and the corporation are separate entities, and as such, you are taxed separately. Some claim it's double taxation. Well, that's nonsense, because a corporation is a juristic individual, and you're an individual, and anytime money moves between individuals, it is taxed. If a corporation does not like it, they can reorganize as a partnership. And in a partnership, the owners are taxed as it's just a one-shot thing. So you notice they don't do that, though, because that limited liability thing is very, very important to them. Okay, firms pay corporate tax rates. After-tax earnings are paid to stockholders as dividends. We just talked about this. The dividends can be taxed as personal income. Yes, when I get dividends, I get taxed. They can be higher or lower than the rest of my income or other parts of my income. In the real world, firms pay a fraction of what they should. So in the U.S., the tax rates are 42%. Oh, no, they changed. They dropped them to 37. No, they dropped them to 21. And who knows what's going to happen in the future. But I have it from actual corporate accountants that they pay around an actual rate of about 3% or less. So note that when corporations keep profits, they don't pay them out as dividends. No tax is paid on the profits. So they don't have to pay tax on profits they don't distribute as dividends. They usually keep part of their profits for growth, to pay off debt, buy new buildings, et cetera, et cetera. You hear a lot about capital gains, and capital gains are when the price received from the sale of a stock is greater than the original price that you paid for it. It doesn't just have to be stock, but in this case, that's all we're going to be talking about. If a future stock sale price is greater than the past buy price, you have capital gains. So lower taxes are often charged for capital gains. You have to check that out again with your tax attorney. Let's do an example. So I buy some Microsoft stock for $100 per share. I sell it 7 months later for $112 per share. Capital gains are $112 minus $100, or $12 per share. And I may have to pay tax on that $12 per share. Advantages of corporations. Well, they have limited liability. As we've discussed before, corporate owners, the shareholders, stockholders, are not responsible for the debts of the company. If the company goes broke, the worst that can happen to the shareholder is they lose the value they invested in their stocks. They cannot lose their house, their car, and all that stuff. The corporation is responsible for the debts. Shareholders cannot be forced to pay in additional funds. So in a partnership, if the partners say we need to expand and you need to add more cash, you need to do that. But in a corporation, they cannot come back to you for more cash. Shareholders don't face direct legal action. Their stock value may go up or down. You can look at some companies lately that have gotten in trouble and their share price will go up and down. But here is a side note: governments could punish bad companies by removing the limited liability and require they organize as a partnership. So a lot of companies complain about this or that, or they do bad things. The government could step in and say, okay, because you have shown that you are not a good citizen, a good juristic person, we're going to take away that limited liability, and now you're going to be run as a partnership, and the people running the company will now be directly responsible for debts and problems caused. If you're a corporation, it's a lot easier to raise capital, especially if you're bigger. You can use retained earnings. So these are profits that you haven't paid out. They're things that should have gone out as dividends or whatever, but you kept part of that to build a new building. You can borrow money, you can go to banks, you can sell bonds, you can do equity capital. So you can go to external investors and ask for more money. Here's a note that I always tell people, that notice that you can never go bankrupt if you never borrow. If you're never in debt, if you never borrow from your suppliers, banks, whatever, you can never go bankrupt. Remember that if you're a small business owner. Ease of transfer of ownership. So if you're in a publicly funded corporation, one of these big things, yeah, you can go to the stock market, you can go to your broker, you can buy and sell your shares, no problem. There's specialized management, so you have status, compensation often allows them to attract better people. Yeah, big corporations can pay more. Working for the big name companies is appealing to a lot of people, gives them more power, and therefore the big companies can oftentimes hire better people. Consistency and perpetual life. So what happens to a customer's standpoint when the CEO retires and dies, etc.? Really, it's not much of a difference unless the company is on the verge of problems or something, or they're in a bailout situation. If a CEO retires, they just bring in somebody else. Let's talk about the disadvantages of corporations. There is the complexity and the expense of formation. They are more expensive to form than any other type of business. They have more government regulation, paperwork, filing fees are higher. Publicly funded firms are required to make financial data disclosures. There are some exceptions, but for the most part, that's true. The public and competitors can see the financial information about how the company is being operated, what they're spending money on, and salaries. This is in lump, of course. They can't see individuals, but they can see the lump. Then there are agency problems of corporations. This is when the managers do not act as responsible agents for the owners of the company, the shareholders. Yeah, they may use expensive business transportation that is, very luxurious. They may have private jets. They may have luxury items that just are not called for. Yeah, so such expenses can reduce profits and return to shareholders. And then there's something called executive blackmail, where the executives threaten to expose information about the company that will kill the share prices, or illegal activities that will damage the company. So yeah, this is a pocket summary of the different things we've just discussed: sole proprietorship, general partnership, C corporation, and different aspects of each one, and whether it's hard or easy to perform under each. So for example, protect from liability, sole proprietorship is hard, general partnership is hard, C corporation is easy, and it goes down this way. Good thing to keep in your mind. Okay, well, that's it for part 2. Let's go on to part 3.